Most people think big moves begin with big headlines. That is almost never true. The move usually begins much earlier, when some rule changes quietly in the background, when inventory starts tightening in a place nobody normal ever checks, when the paper market keeps pretending the old world still exists, and when a ratio buried in some chart is already screaming that reality and price have drifted too far apart. By the time the headline arrives, the serious money has often already moved. That is why I find silver so interesting right now. Not because it is shiny, not because somebody's grandfather kept a few coins in a drawer, and not because I enjoy dramatic commodity stories. I care because silver is sitting at the intersection of three things that matter enormously in markets. Rule changes, physical scarcity, and investor neglect. That is a dangerous combination if you are on the wrong side of it, and an unusually powerful one if you recognize it before the crowd does. Now, I want to begin with a point that almost nobody in the public thinks about properly. Prices do not tell the whole truth. Prices get pushed around by inflation, by the dollar, by headlines, by leverage, by sentiment, by television, by politicians, pretending to matter more than they do, and by people who confuse noise with insight. That is why I often prefer ratios. A ratio compares one asset directly with another and strips away a great deal of emotional clutter. The ratio I care about here is silver divided by the S&P 500. That ratio tells you how expensive silver is compared with the American stock market. If silver is expensive relative to stocks, the number is high. If silver is cheap relative to stocks, the number is low. That sounds almost too simple to matter. It matters a great deal because over the last half-century, whenever this ratio has reached extreme lows, the move that followed has often been violent. Not gentle, not polite. Violent silver has a habit of looking ignored, old-fashioned, and almost silly, right before it starts moving in a way that makes people feel late very quickly. That is what the chart is showing. Now, silver is historically cheap relative to the stock market, not in some abstract storytelling sense. In a measurable, historical black and white sense. And that matters because markets tend not to leave relationships this stretched forever. Something eventually gives. Either stocks become much cheaper, or silver becomes much more expensive. Sometimes both move at once. But extremes like this do not sit still politely for decade after decade. Now, I do not build an entire thesis on one chart. That would be lazy. A ratio can tell you when something is unusually cheap or expensive, but it does not tell you why the structure beneath that relationship is changing. For that, you have to go deeper. You have to ask whether the plumbing of the market itself is being altered because, in my experience, the largest moves in financial history usually trace back not merely to emotion but to changes in structure. That is where the silver story becomes far more interesting. There has been a quiet rule change in the background and almost nobody outside a narrow circle has paid attention to it. Basel III, I know the phrase sounds like one of those things that should put people to sleep at a banking conference. That is precisely why it matters. Quiet rule changes are where the real money often gets made or lost because the public is never looking there. Now let me explain it plainly. For many years, large institutions could operate in the silver market through unallocated silver. That is a very nice phrase for something much less substantial than it sounds. Unallocated silver is basically a claim, a promise, an IOU structure, not necessarily a specific bar with a specific owner's name. Sitting quietly in a vault, the paper market became enormous because it was easier, cheaper, and more flexible to trade promises than to move real metal around. That structure gave the financial system a great deal of room, and it also gave it a great deal of power because when a market is dominated by paper claims, the price of the real thing can be influenced by the creation of more paper versions of that thing. Now, Basel III changes the economics of this arrangement. It makes unallocated precious metals activity much more expensive for banks from a balance sheet and funding perspective. What used to be easy paper leverage becomes less attractive. What used to be a profitable little corner of the machine becomes more capital intensive, more cumbersome, and less fun for the institutions that once played there casually. That matters because when you make paper silver less attractive, you do not make demand vanish. You redirect it. And where does redirected demand go? Toward physical, allocated metal, toward the real thing. That is the part people miss. A rule change does not have to announce itself with fireworks. It only has to alter incentives enough that the big players slowly stop doing what they used to do and start preferring a different form of the same exposure. Over time, that changes the floor under the market. Not because a television commentator shouted bullish, because the structure itself shifted. That is a much stronger reason. Now let me add the second rule change, because one quiet change is interesting. But two moving in the same direction is something else entirely. China. Most Americans still do not understand how much of the world's industrial story now runs through China. And silver is no exception. China is not merely a large user of silver. It sits in a central position in refining, processing, and downstream industrial demand. So when China changes its export system for silver, that is not some technical footnote. It is a structural event, and that is exactly what has happened. The old, looser export framework has been replaced with a tighter licensing system. In plain English, silver does not leave China as casually as it once did. And if Chinese refiners and related systems are responsible for a very large share of the world's refined silver exports, then tighter control at that choke point matters for the entire globe, especially because China is not just a gatekeeper, it is also a giant internal consumer. That is what makes this so powerful. If China tightens the export route, while domestic Chinese demand remains strong or rises, then the rest of the world gets forced to compete harder for what leaves the country. That is how a quiet bureaucratic change becomes a global pricing issue. Now, what is that silver being used for? This is where the old, sleepy image of silver becomes almost absurd. People still think of silver as jewelry, coins, spoons, maybe some old cutlery in a family drawer, and of course some speculation by people who like metals more than spreadsheets. That is an antique understanding of the market. Modern silver is an industrial input. Solar electronics, data centers, medical applications, telecommunications, electric vehicles, high conductivity applications across the modern economy. This is not the story of a decorative metal waiting for nostalgia to save it. This is the story of a critical industrial material sitting inside the electrical and digital architecture of the future. And when you combine that with the fact that the solar industry alone consumes a huge share of annual silver supply, the picture changes completely. A material once dismissed as boring suddenly becomes a supply chain problem. Not because silver became glamorous, because the world found more and more technologically essential ways to burn through it. That is what separates industrial commodities from stories. The demand is not philosophical. It is physical. Now we come to the third part of the structure, and this is where things begin to look genuinely tight. Inventory, specifically exchange-linked visible inventory. A great many investors make the same mistake with commodity markets. They imagine that if there is still metal somewhere in the world, there cannot be a serious issue. That is childish thinking. What matters is not only total existence. What matters is accessible, deliverable, financially relevant supply in the parts of the system where claims are being made against it. That is why exchange inventories matter. If the market trades huge quantities of paper claims while the registered deliverable stock keeps shrinking, the structure becomes more fragile. Not because silver runs out in some Hollywood sense, but because the ratio between paper obligations and physically available inventory begins to look less comfortable. That is the sort of tension that does not matter until it suddenly matters a great deal. And this is where COMEX becomes important. Visible exchange stocks have been under pressure. Industrial users continue drawing physical metal. Long-term holders continue removing supply from easy circulation. Large pools of silver do still exist. Yes, but the tighter the deliverable slice gets, the more sensitive the system becomes to demand surges, disruptions, and stress. This is why I dislike the phrase "they found more silver" whenever inventories move around a little. It misses the point entirely. The question is not whether another pile exists somewhere. The question is whether the overall system is becoming tighter relative to the claim sitting on top of it. That answer appears to be yes. Now, I want to pause here and say something very important. This is not a guarantee of a straight line upward. Nothing in markets works that way. Silver is volatile. It can frighten people badly. It can move 10% in what feels like no time. It can overshoot on the upside and punish late buyers just as ruthlessly as it punishes weak hands during drawdowns. That is the nature of the asset. Any honest discussion of silver that pretends otherwise is not an education. It is salesmanship. I have no interest in salesmanship. What I care about is the structure. And the structure here is unusually compelling. The ratio to stocks is historically depressed. The regulatory treatment of paper silver has become less friendly. China has tightened export control over a globally important choke point. Industrial demand remains structurally powerful. Visible inventory stress is real enough to matter. and the public remains mostly asleep. That last point is what makes the setup so interesting. Because if everybody already understood all of this, the price would likely look very different. Now, I find that when people are presented with a story like this, they ask the wrong next question. They ask, so should I buy silver right now? That is not how I think. I think in frameworks. The first signal is the ratio, silver versus the S&P 500. If the ratio is at or near extreme historical lows, then silver is cheap relative to stocks and the asymmetry becomes more favorable. The second signal is supply and demand. Not storytelling demand, but actual global balances. Is the world consuming more silver than it is producing and recycling? Are deficits persistent? Are inventories being leaned on year after year? If the answer is yes, then the structural pressure is not imaginary. The third signal is the rule book. Are regulations, policy choices, or classification changes making the physical market more important, and the paper market less easy to manipulate, warehouse, or fund? If the answer is yes, then the floor under the asset may be moving, even if headlines have not caught up. That is the framework ratio. Balance rules. You do not need a television anchor to tell you what to think if you can track those three things. Honestly. Now, one more point matters here, and it is bigger than silver quiet. Rule changes are how the world really changes. Retail investors are always staring at the visible flame. The institutions are studying the gas line. That is the difference. The public sees silver as a shiny object that occasionally gets speculative. The serious observer sees a market where paper leverage is being made less attractive. Physical export control is tightening in one of the most important industrial nations on earth, and a critical material remains historically cheap relative to financial assets that everyone already worships. That is not the same story at all. Now, am I telling anyone to bet the farm? Of course not. That would be idiotic. Silver is not a bet everything asset. It is a high volatility, structurally interesting asset that deserves respect, sizing discipline, and a plan. The very same factors that make it exciting on the way up make it painful on the way down. Anyone who cannot endure sharp volatility should not pretend otherwise, but that caution does not weaken the thesis. It strengthens it, because the best opportunities are often the ones that require both conviction and discipline, not excitement. And if you force me to reduce this whole matter to one line, it would be this. Silver is no longer merely a metal story. It is a rule change story, a supply change story, an industrial demand story, and a relative valuation story. Those are the most powerful kinds of stories markets ever produce, because when a market is cheap, structurally tightening, quietly re-regulated, and still ignored by the public, the eventual move tends to feel obvious only after it has already happened. That is why I am paying attention, not because silver suddenly became fashionable, because the floor beneath it may already have moved. And when the floor moves first, price usually catches up later.